This year has been one of the strangest moments for the bond market in recent memory. The Federal Reserve has already cut short-term interest rates twice, yet long-term rates have climbed higher. Mortgage rates have climbed too. So the question everyone keeps asking is simple: who actually controls interest rates? According to Bloomberg's Hannah Benjamin Cook, Claire Rutkin, Caleb Mutua, and Prashant Gopal, global bond issuance has hit an all-time record, $5.95 trillion in 2025. That's right, almost $6 trillion in new debt this year alone. Governments are issuing bonds to fund deficits. Corporations are issuing bonds to build data centers and fuel mergers. Private equity continues to borrow to grow. Everyone wants capital. Everyone is competing for the same investor dollar, and that means supply is flooding the market. The International Monetary Fund recently warned that global debt will surpass 100% of world GDP by 2029, the highest level since nations were rebuilding after World War II. Now here's where it gets tricky. As Wolf Richter reported in Wolf Street, every part of the Treasury yield curve from 3 months to 30 years has risen since the Fed's last rate cut. Think about that. The Fed cuts rates to lower borrowing costs, and yet the market responds by pushing yields higher. That's because investors aren't buying what the Fed is selling. They're nervous about inflation. They're nervous about too much debt supply. So they demand higher yields to protect the value of their investments. That's what's driving long-term mortgage rates higher, not just the Fed's short-term policy moves. If you're in real estate or mortgage lending, this matters because even if short-term rates drop again, long-term rates may not. The global bond market is now calling the shots, and until inflation cools and the supply of debt stabilizes, we should expect continued upward pressure on long-term rates. So when people ask, when will rates finally come down, maybe the better question is, who's really in control?